Well, hello everyone. I'm Judith and I'm here with Taylor, and we're going to visit today about the reverse mortgage. Excuse me. We're not here to sell you anything. We are here to educate you so that you can make an informed decision about the reverse mortgage, because it might be right for you. Nothing's right for everyone, but this is a terrific program. What do you think the number one myth about the reverse is? What is it?
Most people assume that the bank owns the home if you do a reverse mortgage, and that is not factual. The borrower always owns the home. They're always on the deed of trust, and the bank never owns the home. The only way the bank could ever take possession of the home is if the borrower does not continue to pay their property taxes and their homeowner's insurance.
Okay, so we're talking about property taxes and insurance. So that is, I guess, the reverse mortgages. If you do a reverse, then your monetary responsibility is to maintain and keep current your property taxes and insurance, correct?
That's right, yeah, because when you do a reverse, you never make a monthly mortgage payment, and these are non-recourse loans. What that means is that the house stands for the debt, which is why you don't make any mortgage payments. The interest is added to the loan balance on these. It's a negative amortization loan. So all you have to do is keep paying your property taxes and your homeowner's insurance, and the bank will never foreclose on you or anything like that.
Okay, so we used a big term there, negative amortization, and what that means is then when we do the reverse mortgage, then their balance goes up every month by the amount of the monthly accrued interest and by the amount of the monthly accrued FHA mortgage insurance premium. Is that correct?
That's right, yeah. It's added to the loan balance. So the bank waits until the very end of the loan to collect all of the interest in the mortgage insurance, versus on a regular traditional mortgage, which everyone is used to, you make payments up front each month. And every time on those payments, about 90% of that in the first half of the loan, it's all going towards interest. It's because like your monthly mortgage payment may be $2,000, but your balance you're paying $2,000 a month, but your balance is only going down $200 a month. So the bank collects all the interest up front on a regular traditional mortgage, and on a reverse, they wait until the very end and collect all of the interest at one time.
Okay, so now let's see, what do we say? First of all, we own the home like we always did. We're not making any monthly mortgage payments, so that's great. We do have to, though, we have to maintain and keep current annual property insurance and taxes, and that's the one thing that would cause default on the note. Foreclosure. If you do not keep your taxes and insurance current, and of course maintain the home in reasonable repair. All right, and one other thing I'm kind of confused about, if my balance is going up every month, what happens at the end when, I guess sometimes the note becomes due and payable? What happens if I'm, what do they call it, upside down? How does that work?
Right, so the note becomes due and payable. There are three different ways. Either both borrowers have passed away, or they have decided to sell the home, or each of them have moved out for 12 consecutive months. In other words, they had to go to an assisted living center or something like that. Okay? So at that point, let's say the loan balance now has grown to $400,000. Okay, but the house, it didn't appreciate for that much money. So now the house is only worth $300,000. So you're upside down $100,000. That $100,000 is forgiven by FHA because these are non-recourse loans and there's mortgage insurance on all of these notes. So non-recourse means that the house stands for the debt no matter what. So even though it's upside down $100,000, no debt is ever passed on to your heirs, period. No
That's
matter
good.
what. And if the heirs want to, if they want to keep the house, even though that loan's upside down $100,000, they can buy that buy that house back for the then 95% appraised value of that property.
Gosh, so in that case, let's see, on $300,000, that they could buy that house back for $285,000 and satisfy the $400,000 debt.
That's right.
Well, that's a lot different from the forward world, isn't it?
That's right.
In the forward world, that's called a bad thing. Foreclosure, short sale, bad credit. Talking about credit, that's another unusual thing about the reverse mortgage. So these loans never, ever, or even on anyone's credit report because they're not making a mortgage payment. No mortgage payment.
And on the flip side, though, when the note becomes due and payable, let's say you still owed the $400,000 on that loan, but the home did appreciate like everyone thought it was going to, like normal. Well, that house is worth $500,000. So the heirs sell the house if they would like to, and they keep that $100,000 profit because they owed $400,000 on the note. It's just like when you sold a home with a regular traditional mortgage on it. You simply just have to pay off that note. So if there's a profit to be made, they do get to keep it. If it's upside down, they go through, they're going to sign some legal papers. I mean, eventually that house is going to be turned back over to HUD. It'll become a HUD home. But all the monies that their parents got from the original reverse, they got to keep all that money. And they never pay taxes on it either.
Yeah, that's great. It's kind of a no-brainer. And the key is you got to understand it. Just take the time to understand it. Now let's see. What about, gosh, does my home, if I want to do the reverse, does my home have to be free and clear? But what if I got a mortgage on it? What happens then?
Right. So if you have a mortgage on it, right now, if you're 62 years old, so the bare minimum age to do the reverse,
okay.
If you have about 50% equity in the home, you would be able to have enough equity to pay off your existing mortgage and eliminate your mortgage payment. So, for example, if the home is worth $300,000 and you owed $150,000 and you were 62, that'd be just enough equity basically to pay off that note of $150,000, and then your monthly mortgage payment would go away forever as long as you live in that house. So if your monthly payment is $1,500, every year you're going to save $18,000 in cash flow.
That's huge, because your cash flow immediately improves by the amount of your current principal and interest payment.
That's right.
Now that is a big ticket.
Right.
Now let's see, we've talked about...
and so let me talk about the line of credit also.
Okay, yeah, let's do that.
So that same example, let's say they didn't have that $150,000 mortgage.
This is really neat.
So now they have, their house is paid off. So if they want to, they have access to $150,000 in cash. Now they don't have to assume that money at closing. If they want to, they can leave it in a line of credit where it earns at a growth rate. Now FHA calls it a growth rate because if they called it interest, then they would have to tax them on the money that it earns. But right now, that line of credit is growing at a little more than 5%, okay? So
annualized.
Annually, yeah. So 150,000, after 1 year, there's going to be, what is that, 7250?
Yeah, a little over $7,000.
A little over $7,000 it would earn just sitting in there in the bank. Now, nothing right now is paying that like that. I mean, no checking account or CDs or anything like that. And that money doesn't start it's not added to your loan balance until you assume it.
So you take possession of that money.
So if you don't need the money, you can leave it in there and it's earning for you. And then when you do need it, then that's when it would start, increasing your loan balance.
And that line of credit is something that people just really don't understand, and it is a huge, huge benefit to the reverse mortgage borrower. You have several options, and you do not have to decide how you want to take your money until we've gotten the appraisal. But you can take part of the money up front in cash. You can take part up cash. You can have a monthly annuity if you wish, or you can leave it all in the line of credit, or a combination of all three. So there are all kinds of things that you can do with the reverse mortgage product. And in a way, it's just kind of a no-brainer.
You don't pay taxes on any of it.
Yes, remember that. No IRS taxes on any of the proceeds of the reverse mortgage. Now let's see, let's go over again one more time. What are the borrower's obligations under the reverse?
Just to pay their property taxes and homeowners insurance, and also keep the property in reasonable repair.
You know, and that's something, folks, that you would do anyway.
Right.
So, as my husband would say, the whole thing is a no-brainer. You've got a non-recourse loan, which means you, the individual, you have no personal liability to pay that loan back. Now, you know, that sounds funny, but that's just the way it is. It's a great program, and don't be afraid of it. You might not like it, but you might fall in love with it.
First of all, you should give us a call. And just to run the numbers, you know, it's a lot less invasive than a normal mortgage. Basically, we just need your birth dates, the property address, and then if you owe anything on a mortgage. And then
the approximate value.
Yeah, the approximate value. And then we're going to do some research also online to see if that makes sense.
The value.
The value of the home. And then we run the numbers. I'll either email them to you or mail them to you. Once we go over that, if you guys want to proceed, the next step is every single senior, you have to do reverse mortgage counseling. FHA made that part of the rules. It's just a third party that has no monetary standing in the loan. Basically, they're going to do the same thing that I did with you. They're going to go over those 4 pieces of paper in the beginning, and you can ask them any questions that you want. And once you complete the counseling, that's when we're really allowed to really get moving forward with the loan, order an appraisal, things like that.
And you know, I think another thing about our approach, and Taylor and I have been doing the reverses since they were legally able to be done in the state of Texas since the early 2000s. And I always say I have turtles and I have jackrabbits. And my turtles are very methodical and they want to take their time, and we want them to. We never ever, not in the forward world or any lending that we do, I do not believe in taking what I call the shove it down your throat approach, because that's not good. We want our reverse borrowers to understand the product, and they can ask any questions, and some of them will take a couple of years sometimes. And then when they call, boy, they're ready to go and they want to close in 32 seconds. That's not quite that quick, but that's the jackrabbits. And some of them are jackrabbits from the very beginning, because, you know, I think more and more people know more and more about the reverses than they used to. But still, a lot of times, they don't have all the facts really quite straight, because it is very, very different, and we want to take the time to make sure that everyone does understand it, and that's what we're here to do, to help them with that. For a complimentary consultation, I'm going to give you an 800 number if you are out of the DFW area, and that is 1-800-887-0065. Thank you, bye.